Hi, good morning from New York City. I want to first of all thank the Arab EmTech conference team for inviting me to speak today, and especially Iman, who's been kind of working tirelessly to make sure this conference. She and her team are working tirelessly to make sure this. Yeah. Is there an audio problem? I'm assuming everybody can hear me.
Yeah, I can hear you very well. I was like welcoming you to our conference and saying like, thank you for coming. And so you didn't hear me. I'm so
I didn't
sorry.
hear you. Yeah, I can hear you now. So
Okay, it's okay. Just I want to thank.
yeah, go ahead. Yeah, go ahead. Go ahead,
Yeah,
please.
please. I want to like thank you so much for accepting our invitation. I will pronounce your name in Arabic. I know I know both know that your name is Arabic name, Mr.
Yes.
Jamiel Sheikh. He
Yes.
is founder and CEO of Chain House. I hope I pronounced it right.
Yes. Yeah.
And I would like to thank him so many times for his support, for his understanding, for accepting our invitation, for this amazing session. I'm the one who understand what is DeFi, what's the hell of DeFi from January. Yes. Your session was amazing, and I don't want to waste any second from it. Thank you so much.
Okay. Thank you, Iman. So yeah, as I was saying, I know the team is doing an incredible amount of work to make this a success, and clearly it's a success. Is bringing a lot of great people together, and so being that it's the last day, hopefully, Iman, you can get some rest afterwards. So today, what I'm going to talk about is this is going to be a mix of some very basic concepts and then some more advanced concepts around automated market making, and it will be a little bit quantitative, right? So there's going to be a little bit of math involved, nothing crazy, just some simple arithmetic. And if you understand that math, then you will understand how automated market making works today. So whether it's Uniswap or PancakeSwap or all these other platforms, they all work in a similar manner. They use algorithms, and I'm going to kind of cover what those algorithms look like. So what I'm going to do is do a little brief introduction to DeFi and define DeFi. The reason I define DeFi is because I define it in a very different way than the market does. And I'm actually currently writing a book for Columbia University Press called The Decentralized Finance Phenomenon, which I cover in great detail some of the DeFi concepts. And I define DeFi in that book in this way, which I'm going to present to you. And then I'm going to cover how traditional exchanges work, because we're going to focus on exchanges, how classical decentralized exchanges work. And classical today means anything that's more than a year ago, more than 2 years ago, is now considered classical in the blockchain world. And then how Uniswap works and how liquidity pools work. And then the centerpiece is understanding what's called the constant product formula, which is kind of the game changer, if you will. And then there's some concepts like divergence laws, which a lot of people don't understand. Even people that are using automated market making tools like Uniswap or PancakeSwap are not familiar with divergence laws or how it works. And I'm going to kind of show you some of the math behind it, how it works, and there'll be some graphs and charts. And then I'll share with you all of that math on a spreadsheet. I basically created a spreadsheet. I'll share that link with you on that spreadsheet. You can go to that spreadsheet and then you can like dig into that math, and hopefully that will help you understand some of the underlying things. Now, there are more complexities. This talk can easily be like I requested that this talk be an hour. Even that might not be enough. This easily can be like a 3-hour session. There are a lot of things that we might not be able to cover. But if you are looking to learn about the underlying mechanics of how AMMs work, then this is the kind of the talk that will help you introduce you to some of those core concepts, right? So let me get started. And the first thing I like to cover is what is DeFi, and then there's a bunch of definitions in the market about what DeFi is. It's a movement. It's an idea that transformed the old financial world to the new world, blah blah blah, and things like that. And you see, I pull some definitions from different academic papers. Here's an example of one defining what DeFi is. My definition of DeFi is very, very different. So for me, DeFi is the Darwinian, and I would use the word Darwinian in the dictionary definition of Darwinian is extreme competition. Nothing to do with theory of evolution, but the Darwinian crowdsourcing and open sourcing of gamified financial engineering, meaning that the entire public now, anybody, if they wish, can now perform financial engineering, right? And that financial engineering is through code. That's very, very, very powerful. That's kind of like what the open source world did to software 20 years ago, 30 years ago. This is now coming to the world of financial engineering. Even if you don't have a finance background, you can pick up a finance background and then start building brand new products that may not even exist in the market, that nobody even thought of. And then you can put it out there and people can engage with that product, whether they're buying or selling or trading on that product. That's what DeFi is. It's the ability to now crowdsource, meaning you, me, all of us can now sit down, and some of us may be technical and we can code, some of us are not. We can always hire somebody who can code, or you can design conceptually some economic model and then you translate that to code and then you deliver that. Uniswap, for example, is about 300. It's only about 300 or 350 lines of code, right? And it's transformed the world. And so it's Darwinian, it's competitive, it's almost brutal. That competition is brutal because people can take open source code. If some platform is successful, somebody else grabs that source code and clones it, forks it, and creates a competitor copy within minutes, if not a day or two. And that's a game changer. That means there's going to be an enormous amount of competition and enormous amount of innovation coming in that space, right? And because of this, it's challenging to newcomers. A lot of newcomers are struggling with it. And when I say newcomers, I'm talking about even blockchain experts. People are very comfortable with blockchain. They're good with Hyperledger. They're good with Ethereum. They understand all that works. And then when they get into DeFi, they get lost because it's far, far more complex. It's a big jungle, right? So the blockchain world looks like a forest. It's complex. You can get lost, but the DeFi world is this kind of upside down jungle, and people are trying to navigate it. So some key properties of DeFi that I look at, and then we'll jump into how Uniswap works. The one that I kind of think is the most important is composability, but here's some aspects or attributes of DeFi: efficiency, transparency. These are all part of what, because of blockchain. What's not because of blockchain necessarily is the idea of composability, right? And that's the idea that I can take different DeFi protocols and snap them together like Lego blocks. So one token in one protocol can then interact with another token or another protocol. And that interaction creates a unique situation. One, there is upside correlation, meaning that if one protocol succeeds, it benefits all the other protocols, right? But if one protocol fails, it doesn't necessarily bring down the entire system, even though there may be some limited cascading effect in this downward correlation, that if one protocol fails, it shuts down and it's isolated. That doesn't exist in the traditional financial market. So if one bank fails, one very large bank fails, then it can wreak havoc in the markets, as we saw with Lehman Brothers, who I used to work for at 2004, 2008, and the banks at that time, Bear Stearns and all those banks. Right. The other key aspects is it's a 24/7 market. There is no open hours, closing hours, none of that. And if you are building a financial product using DeFi like Ethereum or Polygon or Binance Smart Chain, there is almost zero to very minimal infrastructure costs, right? So typically in the SaaS world, if you're building a SaaS product, you need to think about, well, how am I going to deploy this? How am I going to scale up my deployment? I need to use a cloud provider to host all my data and all that kind of stuff. And with a DeFi, you don't need to worry about all you need to worry about is what does my protocol do in terms of the business model, its economic model, and I deploy it. And I'm done. I don't need to worry about computers and nodes and things like that. Maybe only during the development cycle, those are a bit of a concern, but beyond that, it's not. And what that means is there's faster time to market and greater focus on the business logic than there is on focus and money spent on infrastructure, which has typically very little return on investment. So that's very, very different from a typical application that you build. Then you need to think about infrastructure costs. So I'm going to skip one or two of these slides regarding where DeFi is today. There are two main metrics that are used, TVL, total value locked, market cap, to gauge the size of the DeFi market. And so you probably have heard of these terms, especially if you've been engaged in this conference. The value locked is how much money is parked into these DeFi protocols, kind of like how much deposits a bank has, how much saving deposits a bank has. And we see in January of 2020, it's about $700 million. And then if we forward to today, even though we had a market correction that you can see there, we're at 60 billion. So a significant increase. The trend line is upwards, and I believe that trend line is going to continue upwards, even though we will have up and down cycles. DeFi was very, very resilient in this bear cycle because while many centralized financial blockchain or crypto institutions could not fulfill the redemption requests, there was no issue in the DeFi market, even in this bear market. So in some ways, this bear market stress test a bunch of these DeFi protocols, and the resiliency was demonstrated. So, and then the other metric is market cap. These are DeFi tokens and their total valuation, and we see that kind of also growing. And you can go to CoinGecko.com and kind of see that. Now, what are the different types of DeFi applications, or what we call protocol classification? There's a paper written on that. There's a bunch of different classifications. The one that we're going to focus on today is called automated market makers, or on-chain asset exchanges, if you will. It's a different terminology. But there's a whole suite of other things: loanable fund market, like Compound and Aave, stable coins like Maker, portfolio management, which is something that we are, as a company, getting into, building portfolio management through NFTs, and a whole suite of other things around the different types of DeFi applications. Now, the one that we're going to focus on today is decentralized exchanges. Typically, the metrics that you use in that is TVL and trade volume, right? If you go to DeFiPulse.com, you can see kind of a leaderboard of the different DEXs that are there, the decentralized exchanges, and how much money they've got in terms of liquidity. And then you can also go to some other sites like CoinGecko to get indications on trading volume. Here's an example of CoinGecko, and you can see PancakeSwap kind of quickly being towards the top, and maybe we can discuss PancakeSwap at a different time. But Uniswap, which is kind of the first AMM in the space, has already done, within 12 months, $130 billion in trading volume. In the grand scheme of things, that's not a lot. That's not, like compared to the US equities market, that's nothing. But it's a very strong indicator of what's to come.
Sorry, we cannot see the presentation.
Oh, you lost the presentation? Okay, so... Do you see it now?
Yes, we see it.
Okay, great. All right. Thank you for letting me know. If it goes away, let me know, because I can't tell if it's...
Sure.
Yep, thank you. So that we see significant trading volume, and that's trending upwards. The day over day delta in terms of trading volume is increasing. The moving average in terms of trading volume is trending upwards. So the question is, how does Uniswap work? And the goal here is to present some of the conceptual underpinnings of Uniswap, and then we'll get into some of the quantitative things. And I spend most of my day and my time studying this stuff. And so I can tell you it's more complex than I'm presenting here, but if you can grasp all of this, then you are going to be in a good position to understand automated market making. So if you look at traditional exchanges, a traditional exchange has what's called a limit order book for any instrument that's being, or any asset that's being traded in a traditional centralized exchange. There is a bunch of bidders and askers that are willing to buy or sell an asset at specific prices. They disclose the price that they're willing to buy and sell, and they're typically called market makers, or it used to be called specialists on the New York Stock Exchange. And then there is a price, a bid and an ask, that it's the best bid and the best ask, which is called the market clearing price. In this case, you see in front, that's $100. You would buy an asset for $100, not at 105. If it's available at 100, you don't want to pay more, so you're not going to pay at 105. You're willing to, you see somebody willing to sell you an asset at $100, you go buy it for $100. This limit order book kind of shifts every second, right? So there's people adding and removing their limit orders to this book. If you come in with a very, very large order, what can potentially happen is that you slide up and you end up buying something at 104 or 103 because of the volume and the quantity that you want, and that's considered a price slippage, right? So slippage is a big deal in exchanges, and any DeFi protocol that's worth anything needs to handle slippage, right? So if somebody comes in with a large order, can they move the market in a significant way? And we're going to see how Uniswap kind of addresses this. And then there's something called price discovery. High frequency hedge funds use this approach where they put up bids and asks and they pull it back down, and they put in bids and asks and they pull it back down. And then from there, they're able to gauge where the market's demand is, right? It's kind of like saying, hey, do you want to buy something at $5? And before you even answer, I put it up $4 and I bring it down to $3, and I see like how your response is. And then if you go quiet, then I bring the price back up, and then you start to respond, then I bring the price down. And I say, okay, I'm going to try to find the optimal price to sell you at. And that's called price discovery. So typically there's a limit order book, but this is a centralized function. The exchange holds the authoritative copy and the constantly updating, dynamically updating limit order book. That's what the core function of an exchange is. There's really not much else that an exchange does that's as critical as managing this limit order book. Execution and trade guarantees, all that is included. Then we moved into the blockchain world a couple of years ago, and everybody was excited. So, well, how do I decentralize an exchange, right? And there was a concept called 0x. There was a protocol called 0x. And a couple of years ago, the way that they work, they decentralized exchanges. So they were called relay. So relay was basically a small little node. You can start up a relay yourself, and that little node manages its own limit order book. And you had what's called makers and takers. Makers were people that made liquidity. They provided liquidity to the market, and takers were people that were looking to extract liquidity or buy, or so makers were supplying, and takers was kind of the demand side of it. And so you had this distributed limit order books with a bunch of different nodes managing their own limit order books, and then makers and takers connecting to specific nodes. And this also led to centralization. This led to poor execution times. This led to liquidity issues. Because, for example, Relay A would have a limit order book, but you had somebody that's connected to Relay B that's looking to buy something. It was not available in Relay B's limit order book, but these nodes would connect and exchange limit order books with each other, and that created some significant overhead. You can pull up some of this if you're interested. You just go to this URL. There's one of these relays called Radar Relay. You can pull up their limit order book. Just punch this URL in, and you can kind of see that book. And it's just an interesting curiosity to explore and to better understand how it kind of works. Now we've moved away from this kind of structure. The market has moved away. DeFi says, hey, this is not going to work for us. There's too many problems. The search cost to find liquidity is difficult because everything's spread out. We still want liquidity in certain places. We want it in one place to find, but we still want it to be decentralized. And so Uniswap came along. There's a guy named Hayden Adams. He was a mechanical engineer at Siemens, didn't know anything about blockchain, decided to play with some blockchain code and implemented some things that existed in some papers and released Uniswap. He got fired from his job, but then Uniswap took off and he started focusing, basically focused on this 100%. Now in Uniswap, there are two roles. Two conceptual roles that exist on a Uniswap platform. One's called a liquidity provider, the other one's a trader, right? And I'm going to go and describe what they are, and then we're going to look at the left-hand side, and then we'll look at the right-hand side, and then we'll see what happens when they all combined, so you have a clear understanding of how it works. Okay, so a liquidity provider is basically what that name suggests. They provide liquidity. They put up assets, right? It's called staking. But they make assets available, right? And a trader swaps assets from one asset to another. And anytime you do trading even in the traditional markets, you're basically doing a swap. Let's say I go to the US equities market and I'm going to buy 100 shares of IBM. That's a swap because I'm swapping a fiat currency for a US equity, right? So I'm saying, hey, here's these dollars and give me those stock certificates, right? And that's a swap. So any trade, you can think of the word swap and trade as fairly synonymous. And every trade requires two currencies or two assets. Whenever you're trading, there's always two assets involved, right? It's the currency, it's the asset that you're using to buy the currency or buy the equity, and it's the asset that you're getting. It's always two different assets. But we're kind of used to in the equities market of thinking only one asset. Well, I'm going to buy the asset, and you don't think of it as a swap that I'm actually exchanging assets, but actually that's actually what you're doing, right? Hence the word exchange. Here's my currency, here's my fiat, and now give me equities. So you have traders that are coming into the market, into this automated market making what's called a liquidity pool. This is where the liquidity providers put their assets in, and they put their assets in pairs, which I'm going to show you, right? But the concept is the liquidity providers put up money, kind of like at a bank, you go put up deposits, and then the bank can go out and lend that money out. They can do stuff with that liquidity. Here, the liquidity is made available to a trader that they can move between different asset types or different asset. So what are their motivations? What are the incentives? Why would you even engage on the platform? So the liquidity provider, they are putting up assets so that they can earn a yield. They know that if I put up $100 worth of asset, I might make 7%, I might make 3%, I might make some percentage, and that's incentivizing them to undertake certain risks. We'll talk about those risks and to try to earn that yield. On the trader side, they move between tokens, different types of cryptos. They have a theory, right? They have a thesis. Their thesis, well, look, I'm sitting on ETH, but I think that another token is going to appreciate faster than ETH. So why don't I just trade out of my ETH and trade into that token that I feel like is going to appreciate faster, and then they go in and make that trade, right? So their incentive, the trader's incentive, is speculation, which is what every trader, the basis of every trader today, like in crypto, and potentially arbitrage, where they see a price difference in the liquidity pool versus the outside market. Okay, so the traders trying to make a profit on the trade, increase their net worth, and the liquidity provider is just looking to earn a yield. Now, they both face risks and costs, right? This is not for free. The liquidity provider faces a specific risk, among other risks, called divergence loss, right? that risk is something that can occur if the price of the cryptos that person parked into the liquidity pool moves, and if they pull out, they can incur a loss. And we'll show you how that works, how that math works. And the trader incurs the risk, obviously the risk that they're willing to undertake by speculating. This token is going to appreciate over that token, but they also face a cost. There's trading fees. So anytime they swap, they have to pay a fee, and so there's an inherent cost to their activity. So they have to be careful and think carefully around how they trade and what they trade. So those are the two actors, and then you have the liquidity pool, which is managed by the Uniswap algorithms, right? And we're going to come into that. Okay, so as I mentioned, liquidity is submitted into a liquidity pool in pairs. If you're a programmer, this is actually the Uniswap Solidity code, the actual down here. This is the actual code for this idea of creating a liquidity pool. It's initialized with a pair of tokens, specific pair of tokens, kind of like the FX market where things are in pairs. You have USD, Euro, and things like that. The same thing with liquidity pool. There are different pools. Each pool is associated with a specific pair, right? And I'm going to demonstrate that shortly. And if you look in the code, for those of you that might be coders, you'll see reference to token 0 or token A, and token 1 and token B as the pair. Okay, and then pricing is inferred. You basically figure out the price for token A or token 0 by just doing simple math, and the pricing is inferred. That doesn't mean that that's the price in the broader market. That's the price, that's the ratio that exists in the liquidity pool, because token 0 and token 1, when they're added in, they must be added in equal value, right? So I have to put equal value of token 0 and equal value of token 1 into the liquidity pool, and that means based on that, I can infer the price of either in relationships to either one, right? I can infer the price. Okay, so for example, I have a liquidity pool and I want to submit, I want to provide liquidity, and I have ETH and DAI, and DAI is a stable coin. You can think of it as USD, crypto USD. I add liquidity into the liquidity pool, and I have to add it in equal amounts, right? I have to add it in equal amounts. And here I am, for example, I'm adding in 1 ETH, and at the time of this screenshot, 1 ETH was around 2,300 DAI. And in order for me to submit this liquidity into the liquidity pool, I have to submit 1 ETH and then the equivalent amount in DAI, which is about 2,300, right? Because these two are equal in value, I can infer the price. I can infer that ETH is equal to $2,300 and change, and I can infer the price of DAI is what fraction of ETH, right? And I submit this liquidity into the pool, and that liquidity now is available to traders. A trader can move between ETH and DAI if they wish, and we're going to see that example, right? Okay, so I'm just making sure there are no questions looking at the chat box. So because there are multiple cryptos in the market, there will be multiple pools. Each pool is specific to a specific crypto pair. So you have an ETH DAI liquidity pool. You can't put anything else into that liquidity pool. Only thing you can put in there is a pairs of ETH and DAI in equal value if you're a liquidity provider. And if you're a trader and you want to trade between ETH and DAI, you trade into this, in and out of this pool, right? So therefore, there are multiple pools. There's ETH and BAT and ETH and so on. There are thousands of these pools. And here is, if you're a coder, here is a factory smart contract that creates these liquidity pools. These so you submit basically a unique token pair, and then a new pool is created if it doesn't already exist. All right. So Uniswap is not one big massive pool of cryptos. It's these tranches or pools of pairs, and you can supply liquidity to any one of these pools or all of these pools, and traders go in and out and they trade between pools, right? So like if they want to trade comp and ETH, they go into this liquidity pool and they trade in and out of that. Okay. Now, when I do supply ETH and DAI, in this case, as a liquidity provider, let's say I'm the liquidity provider, I do provide ETH and DAI, I get back kind of like a receipt. These are uni tokens, right? That kind of is something that I can then use in the future to get my ETH and DAI out. It's kind of like when you go and at a coat check at an event, you give your coat and they give you a number. You come back and say, here's my number, and you get back your coat, right? And that's kind of what the uni tokens is. It does a little bit more than that. And it also has its own price. It's also independently traded. But in general, when I supply liquidity into the ETH DAI liquidity pool, I get back uni tokens, and I can use those uni tokens. I can even stake the uni tokens somewhere else and earn interest on the uni tokens, which is, an example of composability. So let's walk through a simple example of providing liquidity. And then we'll understand what divergence loss is when you pull that liquidity out, and we'll understand what the constant product formula is. This is probably the most important part of this presentation. Hopefully you guys can grasp it. Obviously the slide deck will be available later, so that if you are not fully able to grasp everything here, you can go back and work through this. And obviously if you'd like to contact me, Iman can get you in touch with me. So imagine ETH right now on the market is worth $100, and that DAI, because it's a stable coin, is constantly worth $1. Therefore, the ETH DAI price is 100, right? So the price of ETH in terms of DAI, right, is 100, meaning ETH is worth 100 DAI, right? So imagine in a liquidity pool that already exists, there already exists in it 9,900 DAI and 99 ETH. So there's already a liquidity pool that exists in Uniswap. It already has some stuff in it, right? It has 9,900 DAI and 99 ETH, okay? This is what that liquidity pool looks like, right? This is it's called the reserves, right? If you look at the code, it's called reserve. There's 99 ETH and 9,900 DAI. And what I need to calculate is what's called the constant product. It is a number that is used to describe or size the liquidity pool. It's a way to think about, you can think about it as the size of the pie, or how big is that liquidity pool. And it's very, very simple, right? It looks complicated, but it's very, very simple. I just multiply two numbers, and that is the constant product formula. And we'll see why it's called constant product. It's a multiplication that must be held constant. Its result must be held constant. And so here, X and Y are the quantity of tokens that are sitting in that liquidity pool, right? So I basically take ETH, which is there are 99 of them, and DAI, there are 9,900 of them, and I multiply the two, and I get this arbitrary number. This is called the constant product. It's an arbitrary number, but it's used to manage this liquidity pool, right? That number, as you'll see shortly, is used to manage the liquidity pool and what traders can and traders can't do, okay? So all you need to understand at this point is I'm just taking this number, which let's call this X, and I'm taking this number here, let's call that Y, and I multiply that, and this number here, constant product, is K. Okay, so I'm just gonna go back here. It's just X times Y equals K, and that's your constant product formula. And we're gonna see how it's used and how it becomes significant in managing that liquidity in this pool. Now, all we need to know is like this is something that's tracked. The liquidity pool is tracking three numbers: the amount of ETH that's in it, the amount of DAI that's in it, and the constant product. Let's just call that CP for short. Okay, these three numbers are being tracked in each and every liquidity pool. They're independent of each other, but in each liquidity pool, these numbers are being tracked. Okay, now let's say I submit as a liquidity provider, I'm submitting into this liquidity pool 1 ETH and 100 DAI. I'm adding liquidity in. So my ETH reserves go from 99 to 100, and my DAI reserves in that pool go from 9,900 to 10,000. Okay, I've increased liquidity in this pool. When liquidity increases, the constant product formula is recalculated. okay, it's calculated again. Okay, and I'm just using simple numbers this time, but in most cases, these numbers have like 18 decimal places, right? And I recalculate it, and it's just 100 times 10,000, which means that the constant product is 1,000,000, and that the liquidity provider has a claim against 1% of the pool. They provided 1% of that liquidity, right? Because they provided 1 over 100, right? And 10,000 over 1,000,000, right? So they provided 1% of that liquidity. And they can come back and claim 1% of that liquidity down the road. Okay, they can come back and claim that 1% of that liquidity down the road as the liquidity pool grows or shrinks. And we'll see what happens when it grows and what happens when it shrinks. Okay, this is the important thing to remember, is that I'm tracking this constant product. I get back some number of uni tokens that represent 1% claim against the liquidity pool. Okay, right? Now imagine that the price of ETH goes from $100 to $120. This is where I, as a liquidity provider, potentially sustain a loss. Okay, imagine ETH goes from $100 to $120, and I mark this price in blue, and this blue here is important. It's going to come back. So just please remember that. And everything else kind of remains the same. So DAI is $1, and the ETH DAI is therefore now 120. One ETH is equal to 120 DAI, right? Because ETH has now worth $120. And let's say now I want to redeem my liquidity. Let's say it's a week later or 2 weeks later. I want to redeem. I want to get back my ETH. I put in 1 ETH and I put in 1,000 DAI. I want that back. Do I get that back? You don't get that back. You go through a calculation. The platform does a calculation, and it gives you back a different amount than you put in. Okay, and typically in most cases it's less than what you put in, right? And we're going to talk about that in a bit in terms of why you would want to put in liquidity when you are pretty much guaranteed to get back less, all things holding constant. So I put in my unis. I'm redeeming in my unis. It's like, give me back my ETH and DAI that I provided earlier, and Uniswap does a calculation, right? This is the calculation that it does, right? It allows the LP to withdraw 1% of liquidity, and the quantities that it can withdraw, meaning the X and Y, meaning the amount of ETH and the amount of DAI that it can withdraw, is such that the quantity, if they're multiplied, still equals the constant product. So it's some number X times some number Y that equals the constant product, which at this point is 10 million. And the value withdrawn at the new price, right, is equivalent. Right, the two tokens, the value of the two tokens as they're withdrawn at the new price is equal. Okay, and that looks like something like this. So currently we have X equals, so before, as soon as I supplied that liquidity in, X was 100, Y was 10,000. That meant the constant product was a million, right? So 100, and the value is 100 times X equals Y, and the math here holds out, right? So these are the two requirements that I must fulfill. Now that the price has moved, I need to find X and Y such that the X times Y equals a million. The constant product is not allowed to change, hence the word constant, right? And I must find it at the quantity times here equals the value of Y. Okay, now, yeah, it's a little bit of math, not very complicated math. If you work through it a few times, you're like, oh, okay, I get it. So, but it's constraints. These are simple constraints. And at this constraint, X and Y, we find X and Y, we do a little bit of math. We find X and Y equals 91.28709 and 10,954. These are the X and Ys that allow the two values of the tokens pairs to be equal, the value of them to be equal, and the constant product to be unchanged, to remain constant. And so when I pull out 1% of that, of these two numbers, the X and Y, I'm going to take 1%. I get back 0.91287 ETH, and I get back 109 DAI. I was like, wait a minute, I put in 1 ETH and 100 DAI. Like, why am I getting back different amounts? And that is how constant product formula works. You're going to get back a different amount. Now, let's do a comparison. So let's say just hodl the coins. I didn't invest it. I just held on to the ETH and DAI and let the market move when the market moved versus if I put in as a liquidity provider and got back this different amount, right? I got like, what's the difference? Where would I have been more successful? And if you compare the two, if I had held on to that one ETH and 100 DAI, and that one ETH moved to $120 from $100, my net worth in that portfolio would be $220. Instead, if I did the liquidity provider route, which I just demonstrated, and ETH went to $120, and I would, because of the constant product formula, I pull out 0.91287 ETH and 109 and change DAI, I get back $219. So I take a loss, right? I'm taking a 91-cent loss. This is known as divergence loss, right? And this divergence loss occurs regardless of appreciation or depreciation of ETH, in this case, of the price of the token. The price of the token, it went up. You would think like, wow, I should have made more money. But it occurs regardless of the movement of the price of ETH. And the only time it doesn't occur is if the price of ETH is the same as when you deposited those two tokens, when you provided that liquidity. So if there is a change in price, if there is a 20% change in price, this is your divergence loss. Okay. The only time there is no divergence loss is if there is no change in price. Anytime there's a change downward in price or upward in price, you incur a divergence loss. Okay. This means that all things holding constant, and we haven't talked about other things yet, but all things holding constant, if you put liquidity in and you withdraw liquidity out, in most cases, you're going to sustain a loss. Okay. And this is a surprise to a lot of people. Like, wait a minute, I thought I'm going to earn interest and all this stuff, right? That's on different markets. Those are lender markets and money markets, things like that. But on AMM, you're going to suffer this divergence loss. Okay. And this is basically a graph that shows the divergence over the price change, right? You can see that it elongates on upwards, but it's pretty sharp on downward price movements. Okay, now let's look at the trading side, and then we're going to come back to why you would, put liquidity in as a liquidity provider. Why would you even do that if you pretty much guaranteed a loss? We're going to kind of come back to that. Let's look at the trading side. On the trading side, the trader is looking to buy ETH. So that you have the trader here on the right and say, hey, I want some ETH. I'm willing to put in some DAI. So this is the liquidity pool that they would trade in. They would not trade in any other liquidity pool because those liquidity pools are dealing with different pairs. They're going to come to this liquidity pool and they'll see that there's a certain amount of ETH in the pool. There's a certain amount of DAI in the pool. They're like, I want some of ETH. I want some of that ETH. I'm willing to put in DAI. I'm willing to make that exchange. The question is, how much DAI do I put in to get, let's say, for example, 1 ETH? But when they're trading, they also are submitting trading fees. Now, this is where the constant product formula increases. Every time a trader trades, these fees are added into the liquidity pool and they move the constant product formula, the number higher. And this is what offsets divergence loss. Okay, this fees and the accumulation of these fees. So the liquidity provider is not, what they're looking to do is put money into a liquidity pool that has high frequency of trading. They want to put liquidity into a place where there's high frequency of trading because that means more trading fees, and that liquidity, that constant product number goes up. And as that constant product number goes up, because these fees are added in, right, then that 1% stake that the liquidity provider might have increases in proportion. And the goal is that there is enough of these fees that go in that it offsets significantly the divergence loss. Okay, so the trader's coming in, and let's just look at what the trader does, right? The trader's coming in, right? And they're looking to trade, for example, they're looking to buy, 1.3 for whatever ETH, and they're willing to exchange that for a certain amount of DAI. Okay, and we're going to go through an example of how that's calculated, right? So if I want to know, like, what's the price of ETH in that liquidity pool? How much DAI do I have to provide to buy that ETH? That's a specific set of calculations. We're going to kind of cover that. But trading fees increase the constant product. So the churn, which is a term that means like lots of trades are occurring in and out, people just constantly trading, potentially offset divergence loss. Okay, what that means is you want to be a liquidity provider as early as possible, because you're going to be accumulating more and more of the fees over time than if you were a liquidity provider later in the life of that AMM. Okay, so let's work through an example here. Again, we're back at this liquidity pool. I've made the liquidity pool a bit larger. The constant product is 100 million. That means that's because there's 1,000 ETH and 100,000 DAI. You multiply these two numbers and you get this constant product. And so there's a pretty nice juicy liquidity pool, right? There's a lot in there. And this trader wants 1 ETH for the DAI. So he said, hey, look, give me this 1 ETH and tell me how much DAI do I have to provide for you, because I want to make a swap. That's what they're swapping, right? And so this is the question that Uniswap has to answer. So given a constant product, in this case 10 million, what is the price in DAI to purchase 1 ETH from the liquidity pool, right? I want 1 ETH, and N is the number of DAI that I have to submit, right? N is the number of DAI that I have to submit. How do we calculate for N, right? The way that we do it, we subtract that 1 from the 1,000, that 1 ETH that trader wants. We then divide the constant product by the remaining amount of ETH. That gives me, this is the amount of DAI that needs to exist in order for the constant product to remain constant. Okay, and if I subtract out the existing amount of DAI, that means the trader has to submit 101.01 DAI in order to get that 1 ETH out. Okay, so to obtain 1 ETH from the pool, 101.01 DAI needs to be paid in so that the constant product remains at 100 million. So whenever there's trading occurring, the constant product must be held constant. And the variables, the numbers, the pricing is guided by the constant product, right? So if you want 1 ETH, well, you must submit in a certain amount of DAI such that the constant product does not change, right? That number 10 million in this example does not change. So that's calculated, and the trade is made, but the constant product remains the same. Okay, the supply is adjusted, but the constant product remains the same. And this always occurs at trading. Whenever there's trading, let's say there's no more liquidity being provided, there's only trades occurring, right? The constant product remains constant. Okay, the only time the constant product changes is when liquidity is provided or removed. Okay, and when trading fees are added in. So when trading fees are added in, they're added in as ETH. This ETH value goes up, and then the constant product goes up. Okay, so the only thing that's changing the constant product, but let's say the trading fees were 0, for example. If the trading fees were 0, so we can hold all things constant, the constant product would never change. Okay, so I paid 101.01 DAI for 1 ETH. I said, wait a minute, I thought ETH DAI equals 100 in the market, right? There is a premium that I'm paying for, right? This is a market premium. Okay, this is kind of like price slippage that we were talking about earlier. Okay, there is a price slippage at a pool, a liquidity pool with a constant product of 100 million. If that's the size of the pool, remember I said you can think of the constant product as the size of the pie, right? At different levels of ETH that I want to buy, I'm going to pay higher and higher premium. So it's incentivizing smaller trades, right? It's incentivizing smaller trades, right? And this is price slippage. If I do larger and larger trades, I pay higher and higher premiums. Okay, and if I were to chart this, right, so the more ETH that I take out of a liquidity pool, the more DAI is required, the higher the premium, right, it increases, that jump increases, right? And the more ETH that's taken out of a liquidity pool, the higher the premium. But imagine another liquidity pool that's larger, 10 times larger. Here, this is 100 billion, right? This is a larger liquidity pool. You can see that the premium, even though there's still a premium, it's smaller. So the correlation is that the bigger the liquidity pool is, the bigger the constant product is, the less price slippage that occurs. So this is how the market, an automated market, addresses price slippage. As there's more and more liquidity in there, the amount of price slippage decreases. That percentage of slippage, meaning what you pay above the market rate, decreases. Now, why would you not just go to the market? Well, because you can't find that kind of liquidity in the market potentially, right? You might not be able to find a place to buy 900 ETH right away. You might not find that like even on Coinbase, for example, right? So and these are fictitious numbers. I'm not using real numbers. The point is, as the liquidity pool increases in size, and that is indicated by the size of the constant product, right? Before here, I go back here, I had a constant product of 100 million. You can see the premiums are pretty large, and I have a constant product of 100 billion, and the premiums decrease, which means that the larger the liquidity pool is, the less price slippage there is. Okay. I'm just in the interest of time, I'm just going to skip through some of these curves. These curves are available in a spreadsheet I'll share with you guys. But the thing to remember is, as liquidity grows, slippage decreases. Okay, so constant product formula, it's a formula. It increases after liquidity is provided. It's recalculated after liquidity is provided. It's at 9 million. I provide liquidity. It's recalculated afterwards using the new numbers of the reserves added in. It decreases after liquidity is removed. Okay, and it increases as trading fees are accumulated into it. Okay, and that is the incentive for the liquidity provider to put and stake their money, is that, oh, I'm going to get a piece of that, like those trading fees, and that will offset my divergence loss. Okay, so liquidity provider is betting really on trading volume. Okay, they're really betting on trading volume. They're investing in the system, and they would be incentivized to encourage other people to trade. Okay, the more people trade, the more their position as a liquidity provider becomes valuable. Okay, now there's some other features that Uniswap has. There's a feature called routing. So if, say, let's say I want to trade between ETH and some token called ABC, where that liquidity doesn't exist, but there is liquidity between ETH XYZ and XYZ ABC, I can move across pairs. Routing, I can do this type of routing, and Uniswap will do it automatically. It moves stuff from one pool out of another pool and then gets me the tokens I want, but this will double my trading fees, right? And this will be useful until there is an enormous amount of demand for this, and then somebody comes along and says, hey, you know what, let's create a ETH ABC a liquidity pool. Okay, so yep, I have four minutes left. I wanted to cover a little bit about Uniswap version 3. I won't have time to do that. I have this stuff modeled. If you go to this link, Uniswap modeling, bit.ly Uniswap modeling, there's a spreadsheet there. Feel free to download that. All the calculations are there. And I spend half an hour, look through the calculations, and hopefully it'll open up some new insights into how things work. Thank you. And that's why I requested an hour instead of 30 minutes.
Yeah, this is amazing, Jamiel. Thank you so much. I really appreciate how much you could try to simplify this hard concept. I know, especially DeFi projects or Uniswap, because I try to understand this part a little bit. The calculation is very hard, and you try your best to make it more, make it simple as much as you can. Thank you so much.
Sure.
Let me check if we have any question on the chat box. Okay, here we don't have. Let me check the website because we have two chats.
I have a question, if it's possible.
Yeah, we have 3 minutes. You can ask it.
Yeah, sure. So I'm using arbitrage both between the DEXs and the DeFi, and I'm wondering, like, the arbitrage boat, is it like cutting off the cost of the liquidity pool? For example, what's the different I know the arbitrage boat, it's creating income from the different prices between all the dexes and liquidity pool, but I'm thinking about creating arbitrage boat for liquidity pool between the, for example, in Uniswap we have liquidity pool between Ethereum DAI and warped Ethereum and DAI. So if it is it that do you think the liquidity, the arbitrage boots can cut the fees of the LP fees?
Can it cut the LP fees? But you know, which fees? I don't think the LP pays any fees. So are you talking it reduces the divergence loss?
Yeah, exactly.
No, because the in this example, the one that I gave you, a Uniswap version 2, no, but other AMMs, they have different variations of this formula. So that may be possible in other cases. And that's, I think it's a case by case basis. So PancakeSwap, PancakeSwap forked Uniswap and then went off, and then they are free to manipulate or modify. Actually, I don't want to use the word manipulate. They're free to modify how that works. And so there may be opportunity to hedge against some kind of divergence loss. But in this example, divergence loss is inherent in the system. You have no way to go around it, right? In this example, in this Uniswap version 2. But on other platforms, there may be ways to do that if they use something different than the constant product formula and things like that. Constant product formula can be swapped out. Some other formula can be swapped in. And that might make divergence loss contingent upon something else. I haven't seen that. In general, it's not possible to escape divergence loss. But in terms of arbitrage and running an arbitrage bot, there is significant arbitrage opportunities in the market, because the DeFi market is largely fragmented, irrational, and there is significant information asymmetry in that market. So those are the kind of the symptoms you want to be able to take advantage of an arbitrage.
Okay, thank you.
Thank you, Jamiel, so much. If you can, I know Jamiel is doing a lot of educational events. I want you all to like reach out and attend his session, because it's very, very informative. If you don't mind, if you can share with the audience your Twitter or LinkedIn, whatever you prefer, to reach out and follow your accounts.
Sure, I just posted my contact information. It's just Jamiel, Jamiel.io. And if anybody's in New York and wants to get coffee, please let me know. And if you need me anything in the Middle East area, please let me know. I'd love to.
Yeah.
I'm looking for an excuse to travel.
Yeah, of course we will do it next Arab Blockchain Week, inshallah. You must be with us here.
Yes.
I don't know yet what's the country yet, but we have to meet in person, inshallah, in the Arab region.
Absolutely.
Thank you so much.
Thank you. Thank you.
Thank you so much, Jamiel. We have to end the session and go to the next session.
Thank you.
Thanks all for attending the session, and see you. Bye-bye.
Bye.